Plug Power Inc., ticker PLUG, is trading live on the NASDAQ at $2.54. It's down about 1%, just 0.025 cents here at 9:39 a.m. Eastern Time on November 11, 2025. And on the surface, that looks like a boring, sleepy morning for a notoriously volatile stock. That could not be more wrong. The market is not yawning, it's holding its breath. This tiny 1% wiggle isn't a sign of stability, it's the eerie calm you get when a company is so deep in crisis that even the sellers are wondering if there's anything left to take. The real story here isn't the 2.5-cent drop. It's the catastrophic, soul-crushing trading volume that has defined this stock for months, and the fact that it is desperately trying to hold above a 52-week low that represents an almost complete annihilation of shareholder value. The expectation for years was that Plug Power was the key to the new green hydrogen economy. The reality, as we watch it trade for pocket change, is that the company is in a public, desperate fight for its own survival. Let's establish the common ground, the story that got so many people to buy this stock. For the last 5 years, and especially during the 2020-2021 speculative boom, Plug Power was presented as the next great American industrial story. It was the poster child for clean energy. This was the company that was going to decarbonize the global supply chain. They had the fuel cells, the little hydrogen-powered engines that were already being used in forklifts by giants like Amazon and Walmart. The story was simple. First, they conquer the warehouse. Next, they move to long-haul trucking, data center backup power, and then the entire energy grid. It was a narrative of infinite growth, government subsidies, and a cleaner planet. It was so compelling that retail investors, using their Robinhood app or their SoFi Invest account, piled in believing they had found the next Tesla stock. People who were serious about long-term themes put it right into their Fidelity IRA or Fidelity mutual funds, thinking they were making a smart generational bet. The expectation was that you were buying a ticket to a new industrial future, and the stock's parabolic move to over $70 a share seemed to confirm it. Now let's slam into the reality. The reality is that Plug Power has been, for its entire 20-plus year history, a machine for incinerating capital. It has never, not once, posted a full-year profit. The story of a clean energy future was always subsidized by an endless supply of cheap capital from Wall Street. And when that supply of cheap capital ended, the entire business model was exposed as a house of cards. The reality hit its absolute peak late last year when the company filed its quarterly report, the 10Q. Buried in that document was the most terrifying language a public company can use, a going concern warning. This wasn't some legal boilerplate. It was a direct admission from management that the company was burning cash so fast that it might not have enough to fund its operations for the next 12 months. So that grand future everyone was buying, it's now contingent on surviving the next fiscal quarter. This $2.54 stock price isn't a dip, it's the market's cold, sober calculation of the company's odds of existing in 2027. Let's look at the recent movement because it's been a disaster. This $2.54 level is just the latest stop on a journey to the bottom. The 52-week high is over $12. The 2-year high is worlds away. The stock has decisively broken every conceivable level of technical support. This isn't a stock you hold in a passive Schwab Intelligent Portfolios account. The algorithms would have flagged it for sale months ago as a critical risk. The reason for the collapse is twofold, and it started with that going concern warning. The last earnings report was a complete bloodbath. Revenue didn't just miss expectations, it showed that the core business was struggling. But the real horror was the cash burn. The company is spending hundreds of millions of dollars per quarter more than it takes in. Why? Because their grand vision involved vertical integration. They weren't just going to make the fuel cells, they were going to build massive new gigafactories like the ones in New York and Georgia to produce the green hydrogen itself. This is an incredibly expensive, capital-intensive plan. They were trying to build the entire ecosystem from scratch, a feat that even a giant like Apple stock wouldn't attempt. Apple designs the phone. It doesn't build the entire cell network. Plug is trying to do it all, and it's doing it with a balance sheet that's bleeding out. This brings us to the single most important factor for Plug Power right now, the U.S. Department of Energy. The only bull case, the only thread of hope, is a $1.5 billion loan that the company has been trying to secure from the DOE. The expectation for almost a year was that this loan was a done deal. It was the bridge financing that would get Plug's gigafactories online, get them to scale, and finally, get them to a place of positive cash flow. But the reality is that the loan has been delayed, and delayed, and delayed again. The government is doing its due diligence, and in a high-interest rate environment, the scrutiny is intense. Every day that passes without an announcement of that loan's finalization, another group of investors gives up hope. The market is now pricing in the very real possibility that the loan is denied, or that it comes with such restrictive covenants that it doesn't solve the problem, or that it's simply too little too late. This isn't a stock trading on fundamentals, it's trading on a single binary political and bureaucratic outcome. This is why you see insane volatility, why it's a favorite for day traders on Interactive Brokers who are just playing the rumors. The macroeconomic pressure has been the final nail in the coffin. The Federal Reserve's rate hiking cycle was poison for Plug. First, it makes borrowing for an in-debt company almost impossible. But more importantly, it crushes their customers. A company thinking about converting its forklift fleet to hydrogen has to finance that. In a 5% interest rate world, they just don't. They stick with their old equipment. So demand falters at the exact same time that Plug's own costs are exploding. This is the difference between a high-growth speculative stock and a fortress like NVIDIA stock. NVIDIA sells the essential chips that everyone needs for AI, and it has pricing power and unbelievable margins. Plug is selling a product in a nascent industry with negative margins, and it's begging for a government loan. The two are not in the same universe. Analyst actions have reflected this. One by one, the buy ratings have been slashed. Price targets that were once $20 or $30 have been revised down to $5, $4, and now some analysts are saying the stock is only worth $2. That's a brutal reality check for anyone who's been holding. So, what is the future? What is the bull versus bear case from here at $2.54? The bull case is a prayer. It is the absolute straight flush of scenarios. It goes like this. Tomorrow, the DOE announces the $1.5 billion loan is approved on favorable terms. The stock instantly doubles, squeezing the short sellers who have been piling on for months. That cash provides the bridge. The gigafactories in Georgia and New York finally ramp up, and through some miracle of engineering, they achieve scale and positive margins faster than anyone expects. The price of natural gas, a competitor, stays high, and the price of electricity, needed to make green hydrogen, falls. In this perfect dream scenario, Plug survives, stabilizes, and starts to actually grow into its old promises. The bulls would say this 6% drop on the APLD offering is a gift, and they are buying more on their Fidelity brokerage or SoFi active investing platforms. The bear case is simple, logical, and terrifying. Bankruptcy. The DOE loan is denied, or it's too small, or it's too late. The company facing a quarterly cash burn rate that will send it to zero is forced to act. The only option left would be a massive, cataclysmic equity offering. They would try to sell, say, $500 million worth of stock at the market price, maybe $2 a share. This would dilute existing shareholders into oblivion, sending the stock price into a death spiral from which it would never recover. The gigafactories, built with billions in debt, would be sold for scrap. The company's assets are liquidated, and the stock goes to zero. This is the reality that the market is pricing in. This is not a stock for self-investing if you value your sleep. It's not an investment. It's a speculation on a binary event. The people still trading it on Robinhood stock trading are not investors. They are gamblers playing the volatility. I have to ask, for everyone watching this unfold, are you still holding Plug Power, and are you betting on the DOE loan? Comment holding or selling below and tell me why. In conclusion, as we watch Plug Power Inc. hover at $2.54, we are